Hi, I'm Hannah Gorge from DDP Property, and today we are diving into one of the biggest questions for investors in Australia. Should you be looking at capital cities or regional markets for your next investment? Let's break down the pros and cons of each so that you can make an informed decision. Let's start with the big cities. Capital cities like Sydney, Melbourne, and Brisbane have always been the centre of attention in the property market, and for good reason. First up, there is the demand. With larger populations and booming economies, there's constant demand for properties. So whether you're looking to rent out or sell, the market is always active. Then there's the infrastructure. Capital cities boast world-class transportation systems, education facilities, healthcare, and entertainment options, all factors that contribute to sustained growth. And let's not forget about capital growth. Historically, properties in these cities have shown consistent value appreciation, making them a go-to for long-term investors. But as with anything, there are some downsides to consider. The biggest hurdle? Probably the cost. Property prices in cities like Sydney can be sky high, making it a little bit tough for first-time investors to break into that market. And while cities can offer great growth, they are also more volatile. Economic changes, interest rates, or even global events can actually have a huge impact on property values. Now let's shift our focus to regional markets. While they might not have the same glitz as capital cities, they still offer some compelling opportunities. One of the biggest draws of regional markets is affordability. Property prices are generally lower, allowing you to invest with a much smaller initial outlay. In many cases, regional properties also offer higher yields, meaning you could see better returns on your investment month to month. And with more people now working remotely, regional areas are becoming increasingly popular for their lifestyle appeal. This trend is driving demand and, in turn, property values. But it is important to weigh these advantages against the potential drawbacks. While rental yields might be higher, sometimes the capital growth in regional areas might be a little bit slower, possibly less predictable compared to capital cities. Regional markets can sometimes be more dependent on specific industries, such as farming, which means they might be a little more vulnerable to economic downturns. Let's take a look at some real-life examples. Investor A bought a property in Sydney 5 years ago and has seen steady capital growth. Meanwhile, investor B chose a regional town in Queensland and is enjoying higher rental yields and a far more affordable mortgage. Both approaches have their merits, but which one is actually right for you? So where should you invest? Honestly, it really depends on your goals. If you're looking for stability and long-term growth, capital cities might be your best bet, but if affordability and rental income are what you're after, then maybe a regional market could be the way to go for you. Consider capital cities for their strong infrastructure and consistent growth. Look to regional markets for better affordability and potentially higher rental yields. Whether you choose the dynamic capital cities or the emerging regional markets, understanding the pros and the cons is key to making a smart investment decision. I'm Hannah Gorge, and if you found this video helpful, don't forget to subscribe to our channel for more insights into the Australian property market. Thank you for watching, and I'll see you in our next video.